to Retire Smart Austin. My name is Cynthia DeFazio, joined today by Phil Capriotti Sr. of Empower Wealth and Tax. And to our viewers at home, there are some common mistakes that are made in regards to your IRA. We're going to talk about what those are today, and also how do you fix them? How do you avoid them? That's the topic of today's show. Phil, how are you today?
Good morning, Cynthia. Blessed. I'm feeling quite blessed today, and it's good to be with you.
It's good to be with you as well. I always feel blessed when we're in the studio together, and we've had such an amazing response from the viewers, if you will, calling in. They want more information, number one, about the Ed Slott book that we've been talking about, but also information regarding IRAs overall, some tax problems that they're having. So you have been quite busy since these shows have started to air.
We have been. We're getting about, we used to have only accept 5 callers, but we expanded our office. We have multiple offices now. We have multiple financial advisors who are fiduciaries. We've multiplied our administrative staff by an additional 5 key administrators. We're really we're meeting demand and exceeding demand. So it's a lot of fun. We opened up the Georgetown office. We have the grand opening in about 3 weeks. We already have over 150 clients up there that are actually going to make the transition.
Wow.
Yeah. So we've been actually taking about a dozen calls. What happened was since we put in the QR code, we'll get 4 or 5 people call in to make appointments, but we'll get twice that much, sometimes 3 times that many hit the QR code and fast track right to an advisor. The process has been improved so much that we're able to get folks in and out literally within a 2 to 3 week period.
Wow. And
instead of a 2-month period, I had folks saying, you know what, we love what you do, but gosh, it takes so long to get to the bottom line.
Yeah.
And I couldn't help but agree. So the fast track's really working. So folks, if you want to get on the fast track, you're going to see the QR code. You want to click on it. You also want to go to empowertaxbill.com, click that QR code, and let's make sure you don't make one of these many mistakes that most folks or many folks make.
Yes.
And how to fix them. So this is a great program, and I'm excited to do it.
I am too.
So I understand that you are in the process of reading this book cover to cover.
I am. Well, anytime that Phil says, Cynthia, this is something that you need to pay attention to, I listen because you are so knowledgeable. So yes, I'm so excited. I actually downloaded a copy and I'm going to be listening to it through Audible.
That's fantastic. So she tells me that it takes 5 hours to listen to it on the Audible.
Yes.
I don't know, it took me 5 days to read it, but okay. 5 hours. I like the 5 hours.
Yeah.
Folks, the retirement savings time bomb ticks louder. I would recommend, if you don't come into the office, buy a copy of it. It's by America's IRA advisor or America's IRA expert, Mr. Ed Slott. As you know from watching the program, I have been an Ed Slott Master Elite IRA advisor for 18 years. Mm-hmm. One of the benefits of having that, and it really is a badge of honor because we do have to recertify our credentials every twice a year,
which is wonderful.
And well, it helps us know how to help folks avoid the mistakes. So when you come in, you click the QR code and you go through our 2-step process, our retirement income plan and Morningstar report, you're going to get your own copy complimentary in addition to the services that we offer.
Phil, thank you. I mean, that is an amazing book, and I'm so glad that we've been talking about it. And I know today's topic, obviously, some common mistakes that people are making with their IRA or with the RMDs and what have you, just both of those together leads into the first topic, which is not taking your RMDs, your required minimum distributions, on time. Phil, talk about that, because are people forgetting to take their RMDs?
Well, here's what happens, folks, and this is what we see most of the time. Many, especially since the new Secure Act changes, folks are confused on when they need to take the first RMD. I would say 25% of the folks that come into our office don't even know what an RMD is. So they have these qualified accounts. They've had them for years. Many times they have other assets. They're not really spending the IRA. Many financial advisors actually, in a way, I don't want to say brainwash, I think that's too strong a term, or they've urged clients to leave the money in the IRA and let it continue to grow. But with that being said, if you are born before 1960, your first RMD, required minimum distribution, is age 73. It's not 70 and a half. It's no longer 72. They changed that.
Okay.
It's now 73. If you're born after 1960, your first RMD, required minimum distribution, is at age 75. So let's let's get the ground rules straight. You must take it by April 1st of the year after turning 73 if you're born before 1960.
Okay.
Don't know why they make it so confusing. It's simple for us because we do it every day. So you should get a letter from your custodian letting you know this is what the required minimum distribution amount is for this year, and you must take it. Now, they are not required to pay it to you automatically, folks. You have to request it, okay?
Wow.
So now, what is the problem, okay, with that, missing an RMD?
Yes, let's talk about that.
It's a 25% penalty.
Okay.
All right. So basically, if your RMD was $50,000, the tax penalty on that used to be 50%. It would be 20. It would be 25,000.
Okay.
But they reduced that. So it's a $12,500 penalty plus the tax plus, of course, you have to pay the tax on the distribution.
Okay.
In addition to the
taxable.
penalty.
Okay.
Okay. So two things.
Okay.
That's number one. So the first thing is the other issue that we find are folks taking two RMDs in the same year. We'll get into that.
Oh, okay.
And that can cause your Medicare IRMA premiums to blow up in the following year.
Wow.
So you really have to be careful with these RMDs. Once you have the first one set, then you're pretty good. If you're working with our firm, okay, and you have multiple different IRAs, 401ks, you may not have all of your eggs at one fiduciary. Let's say you have an IRA in several different places. You might have money in a 401k. We'll aggregate the IRAs with you, and you can also take the RMD from one account. So that's another mistake that's not even talked about, is many folks think they have to take their RMD individually or separately from each separate IRA. I'll give you an example. I have a 401k out at ABC company. I have to take that. I have my own IRA from a previous employer. I have another IRA that I inherited or something of that nature. So what we can do is we can aggregate them, not for inherited IRAs, but for all of your IRAs and 401ks. You don't want to miss it, and you want to make sure you don't take two RMDs in 1 year.
Yikes. All right, Phil, I know, because obviously one of the other things would be taking too much too soon, and that ties in exactly with what you just mentioned. That can be not good, if you will.
Yeah, no, it's not good. It's a mistake. And to be frank with you, many times the IRS will allow for one mistake. They'll give you a get out of penalty free once, but you really have to go through a dog and pony show to get that exclusion. And what I've found, to be quite honest with you, and again, nothing against the IRS, I've been on the phone sometimes with the IRS for an hour and a half waiting for somebody to come on and actually to talk to.
That's true.
And then many times you get disconnected. So just get it right the first time, and you don't want to fuss with these things, which means give us a call and let us show you how to take your RMDs correctly.
Phil, thank you so much. Yes, give us a call. That number is 888-818-6557. If you're in the viewing audience and you're asking yourself, do I have a strategy for my RMDs? Do I understand some of the common mistakes that people are making when it comes to IRAs? If the answer is no, pick up the phone. Please call in to 888-818-6557. Phil mentioned you can also visit empowertaxbill.com. You can put in some information there about yourself and get an overview of what your tax implications could be without proper changes being made today. Now, one of the changes we're going to talk about when we come back, what about considering a Roth conversion? I'm going to ask Phil that question. Once again, 888-818-6557, or even simpler still, grab your smartphone, click on that QR code at the bottom corner of your screen. That'll take you right to the landing page for Empower Wealth and Tax. We'll be right back momentarily. Stay tuned.
Hello, my name is Phil Capriotti. If you've already filed for Social Security and would like us to fast track you straight to a licensed fiduciary to create your tax-efficient retirement income plan, we'll be happy to accommodate you. You know, one of the most important priorities to ensure that you do not become tax poor in retirement is to, number one, structure a tax-efficient retirement income plan, as well as a comprehensive Morningstar report. This will ensure that you understand three major variables. Number one, how much risk are you taking? Number two, how much return are you receiving? And number three, how much are your internal and external fees? To fast track your meeting with one of our licensed and experienced team members, just click on the link below, complete the form attached so we can provide you with an accurate and detailed plan. Let's start empowering your retirement right now.
Welcome back to Retire Smart Austin. My name is Cynthia DeFazio, joined today by Phil Capriotti Sr. of Empower Wealth and Tax, and we're talking all about some common mistakes that retirees are making in regards to IRAs. So, Phil, I want to ask you about this next one because I know that you love talking about this. Roth conversions. One of the mistakes that we see people make are not considering Roth conversions. Why is that? I knew that was going to happen.
Nice move. Actually, that was a three-point shot. It
Thanks,
made it right into the basket. Went right through the hoop. We've actually built an entire practice on this. So in 2010, the federal government, both of the houses and the Senate, approved the ability to do Roth conversions. Many advisors frown. They don't really talk about it for a number of different reasons. I won't get into them, but if you execute a Roth conversion strategy early on before your first RMD, not only will you build up a taxable, turn a taxable account to a tax-free IRA, but you don't have to take RMDs from a Roth. So the idea is to coordinate your RMDs directly with your goal retirement income and structure it to make your Social Security tax efficient.
Okay.
So there is a tax strategy in this. So most folks, what we find, I'm going to say 90% of the folks that come into our office have never really been schooled or educated on why it's important to execute a Roth conversion strategy, but how to do it properly.
Okay.
So we can actually coordinate. We want to, folks, you want to, in retirement, coordinate what you're receiving in RMDs each and every year. It should be part of your income plan. If your current advisor or advisory committee, okay, if you have more than one advisor, are not helping you with this, you're missing the boat. And chances are you're going to be spending tens of thousands of dollars more in taxes by not doing the planning.
Wow.
Yeah, so
That's
we love
staggering.
the Roth, and they opened up the law for us in 2010. So I would say if you're not contributing to the Roth 401k, or you have not executed Roth conversion strategy since 2010, time's a wasting. We need to get on that project.
Absolutely.
Give us a call.
Absolutely, Phil. And obviously, going to empowertaxbill.com, when people put in that information, they can see what their tax obligation would be right now without making some changes, correct?
That's right. And even further, once you come into the office, what we'll do is we'll run that retirement income plan and Morningstar report. What we want to do is we want to find out what are you actually earning in a return. We want to apply that against the growth of the IRA or the qualified account to help determine what your RMDs are going to be. In addition to that, we want to structure spending out of multiple accounts. Remember, there are 3 different accounts we save in. Tax-deferred accounts, accounts that we are pre-tax, we haven't paid the government off yet. Taxable accounts, they're accounts we get a 1099 from at the end of the year. We have to pay taxes on the income earned, like from CDs and mutual funds, things of that nature. And then tax-free accounts.
Okay.
And these would be loans against life insurance policies, that's tax-free, or withdrawals from Roth. So what we want to do is we really want to use all of these different avenues to create a tax-efficient retirement income plan.
Okay.
Those folks that are out here listening to us this morning, if they're not implementing, if this sounds Greek to them, they should be hitting that QR code, because what will happen is we'll teach you. And once you come into the office, you'll realize, this makes sense. Many folks, this is what we hear, Cynthia, I should have started this 5-6 years ago.
Yes.
And I hear it all the time. So, but it's never too late.
It's never too late, and knowledge is power.
Yeah.
And you actually kind of talked a little bit about this in the first segment, but in case someone is just tuning in, one of the other common mistakes that people are making, failing to withdraw RMDs from the right accounts. I can't even imagine being a do-it-yourselfer and not knowing which direction to go as far as where the withdrawal is going to come from. How do you help people determine?
Well, what we see is folks use the wrong uniform life expectancy table.
Really?
There are 3 different tables to use.
Okay.
So let's start with that one. You want to make sure when you're calculating your first RMD, you're not using a single uniform life expectancy table. Many times they'll just open it up and then multiply the factor. Many times what will happen is they'll take an RMD from one account or a second account and they forgot about the third or fourth account. So what we really want to do is we want to take all of your accounts. You can leave them separate if you like, but we have to look at the value of these accounts on December 31st of the previous year, aggregate that value, and then we can multiply the proper uniform life expectancy code to get your RMD. We don't have to take them out of separate accounts. They simply have to be calculated on all of the accounts. We can take it out of one account, but we can't forget to aggregate all of the entire value. So that's another big mistake that we see a lot.
Wow. Thank you, Phil.
Especially for the do-it-yourselfers.
Oh my gosh, absolutely. I can only imagine. What about rolling over RMDs by mistake? A lot of people are making that mistake. It says it cannot be rolled into another IRA or Roth IRA. Talk a little bit about that before our next commercial
I've seen
break.
folks take a RMD and convert it to a Roth IRA. And like, what are you doing? Well, I didn't need it. And I just thought it would be okay. Here's how this works. You can convert to a Roth after you start taking RMDs. You just can't convert the RMD to a Roth.
Okay.
So for instance, let's assume for a moment my RMD is $50,000. I'm just going to take that number. I can take the $50,000, pay the taxes on the $50,000, and let's say my tax bracket's 20%. Okay, so I take my 50, I pay Uncle Sam 10,000, I have 40, okay? I can now put that 40,000 into a Roth. I have to take another amount above the 50 and move that amount into the Roth. I can use some of the 40 that's remaining to pay the taxes on the Roth, but I can't put the 40 into the Roth.
Okay.
See it a lot.
Wow. All right.
I see it a lot. And most of these mistakes are done, like the first year or two, the first couple years. After about year 2 or 3, most folks get it, the do's and don'ts of RMDs and what to do with them.
Okay. But it can be very confusing without the proper guidance and the proper knowledge.
No.
So, Phil, you have a very special message to our viewers at home, and then we have to take a commercial break.
I don't know what you're waiting for. Pick up the phone and hit the QR code. Come on in and visit with us. Our office is growing in leaps and bounds. One of the very first qualities you have to work in our office is personality. You have to be good at people. You have to like to be around people.
Yes.
And you have to enjoy being around people, and especially making people happy.
Yes.
Because we have a very happy environment in our office. I'm a firm believer in it. Give us a call, 888-818-6557, or click the QR code. Don't be shy. Go ahead and click it and fast track right to empowertaxbill.com. You'll get a follow-up phone call, normally on Monday, either from Erica or one of our other administrators, and to determine which advisor you need to meet with. Whether you're meeting directly with me, maybe you're meeting with my son Philip, maybe my son Parker, maybe Jenna. You might be meeting with Chris. We have a number of different advisors depending on the type of issue you need help with.
Okay, Phil, thank you so much.
Come on in. Let's meet and greet.
Yes, absolutely. You heard Phil. Come on in. Pick up the phone and call in today. 888-818-6557. If you're rushing out the door and you don't have a pen handy, you can grab your smartphone, click on that QR code at the bottom corner of your screen. That, of course, will take you right to the landing page, and you can book your time accordingly. If you're curious about what your tax implications are today without making changes in the future, please visit empowertaxbill.com. We're going to take a very short commercial break. We're talking all about some top common mistakes that retirees are making in regards to their IRA. Stay tuned.
We know the market is going to get worse from here. This is the biggest monthly decline in 10 years. People's 401ks took a major hit.
Well, my investments are tanking. My retirement isn't going as planned. I can't believe I let my kid talk me into buying crypto. I mean, what is that anyway?
This was the fourth worst contraction in history.
So how are you two doing?
Your financial future doesn't have to be uncertain. I'm Phil Capriotti, CEO of Empower Wealth and Tax. If you amassed a nest egg, it's time for a financial advisor to help you reach your retirement goals. This is one of the greatest tax windows in history. Now is the time to take advantage of this tax discount while we can. We specialize in retirement income planning, tax mitigation, estate planning, and so much more. So plan your retirement right. Call now for your own complimentary portfolio review and tax analysis.
Welcome back to Retire Smart Austin. My name is Cynthia DeFazio, joined today by Phil Capriotti Sr. of Empower Wealth and Tax, and we're talking all about some common mistakes that retirees are making in regards to their IRA. Phil, this is a great show because people in the viewing audience are probably listening and viewing and thinking, gosh, I've made some of these. I need to correct this now.
I could see me making that making that mistake. Yeah. Mm-hmm.
Exactly. Well, this next one, withdrawing before age 59 and a half without a qualified exception. Talk about that.
Yeah, right. So for quite some time, they were very limited qualified exceptions. Now, they've made some changes. Many folks, you should know by now, unless your money has been moved over into a Roth IRA, where you've already paid the taxes on the conversion or the contribution, you can't take a withdrawal prior to 59 and a half without getting a 10% tax penalty, plus paying the tax on the distribution.
Okay.
The IRA is designed to be just what the acronym stands for, an individual retirement account. It's to take money out prior to retirement. Now, the government doesn't allow us to be completely retired till 59 and a half with respect to these qualified accounts, unless you have an exception. Disability, and I won't go through that, so that's a topic for an entire show. All you have to do is Google exceptions to the 59 and a half rule, and they'll all come up.
Oh, okay.
I know we have a limited time here, but the fact of the matter is you cannot take a distribution. You can take a conversion. You can do a conversion prior to 59 and a half. You can't take the money. You cannot take that money and put it in your own personal checking account. You could take that money and move it into another IRA prior to 59 and a half, but you can't take possession of it, okay? If you take possession of it, you're gonna have a mandatory withdrawal. But this is a problem we see once in a while. What I really see for most of our folks that come into the office is, I took my first RMD and now all of a sudden, I'm paying taxes on 85% of my Social Security.
Wow, okay.
How do I fix that, Phil? And there is a fix to it. It's called, again, Roth conversions.
Okay.
So what happens is most folks will go along and let's say they're collecting Social Security. And I see this with folks where the first RMD is until 73. So many of these folks will have maximized their Social Security. So their Social Security benefit might be $50,000, $60,000, $70,000 a year between individual and spouse. Okay. So and they're going along, and when we're doing their tax return, or they're doing their tax return, they're saying, oh my, only $5,000 of my Social Security is taxable. Oh my, only maybe $7,000. Oh, none of my Social Security was taxable, based on the income they took from other sources. Now that first RMD comes along, they have to take that first 30, 40, 50,000, and they take the RMD and have to pay taxes on the RMD. And they look, oh my goodness, now $60,000 of my $70,000 in Social Security is now taxable income.
Wow.
So they don't realize that taking the RMD is going to cause their Social Security to be taxed in a much, let's say, less favorable way.
Okay.
This is part of the retirement tax planning. This is why for the last 15 years, we've been telling folks, come in, let's put together a written retirement income plan that's tax efficient.
Absolutely.
Because if you know about it, if I can show you in the office, this is what the tax, and I do this with every client, this is the way your Social Security is going to be taxed before RMDs, if you're taking Roth distributions. This is the way your Social Security is going to be taxed once you take that RMD. That also turns the light on.
Absolutely.
I guess I better start doing Roth conversions. Yes.
It's all about proper tax planning. As you mentioned, Phil, that's what you have been so passionate about. You have always stressed that from all the years that I've known you. And yet it's amazing to me when I think about it, how many people are failing to plan for taxes in the future with their retirement, especially now where there's the known rate.
I have to say it's got to be in the millions.
Really?
It really across the country that don't factor in their Social Security taxation based on that first RMD, and it's a shock. There are so many other mistakes. In fact, we're going to do a follow-up. I think next week we ought to finish this up. What do you think?
There's so much more we haven't even gotten into.
So we're just scratching the surface.
Absolutely.
So there are a lot of different mistakes. So what I would say to you folks is avoid the mistakes. Dial 888-818-6557. Click that QR code. Come on in, and let's kind of help navigate you in and around the potholes of taking that first RMD.
Phil, thank you so much. To our viewers at home, thank you for spending time with us today on Retire Smart Austin. That number to call is 888-818-6557, or you can grab your smartphone, click on that QR code at the bottom corner of your screen. That'll take you right to Empower Wealth and Tax. Be safe, be happy, be blessed. We'll see you next week. Take care now.